Hello, and welcome to this episode of the Profitable Home Services Podcast. This is the podcast where we dig deep into profit and cash flow leaks in your business. I'm so glad you could join us today. Today, I'm going to deviate a little bit from our normal routine of having a guest on the program, and I'm going to talk to you about tax planning. I know you're thinking this is a podcast about profits. What in the world does tax planning have to do about that? Well, actually, tax planning plays an important part in the cash flow of your business and in the potential leakage of profits, because if we're overpaying our taxes, then we are leaking profits out of the business. So let me pull up a little bit of PowerPoint for those of you who are a little more visual and not just audible learners, and you can follow along with me. Okay, as I said before, we'll be talking about tax savings or tax planning today. So I'd like to talk to you about, are you overpaying your taxes? Or are you just paying the legal amount that you have to pay? We all need to pay taxes, but there's nobody that says we have to give the IRS a tip. So let's not give them a tip as we're paying the taxes owed from the profits of our businesses. You might be wondering, what is proactive tax planning? That may not be a term that you're familiar with. Your accountant or your tax preparer may not even be talking about proactive tax planning. That term means that your accountant or your tax preparer is coming to you with proactive ideas on ways that you can save tax in your business as you go throughout the year, ways that you can put more money back in your pocket and pay the legal amount of tax you need to pay. I find that as I talk to people across the US, that many accountants have very little communication with their clients. They're really good at putting little numbers in little boxes, but unfortunately, then they call it a day. They've done the job you've asked them to do, which was prepare your tax return. But they're not thinking ahead. They're not being proactive. So my question for you today is, when's the last time your accountant came to you with a tax savings idea? We want to start in the world of tax planning. I always start with looking at entity types. Are you in the right type? I'm sorry. In the world of tax planning, I'd like to start with finding out if you're in the right retirement plan, or if you even have a retirement plan for your business. There's many different types, and I'm only going to talk about 3 of them today. The first type is a SEP IRA. And this is an IRA that's really set up for that single person business. We don't have any employees, and it's just you. You're able to contribute up to 25% of your compensation for a maximum of $23,000. So that's okay, but there's plans where you can do better. We might want to look at a simple IRA. A simple plan is usually for a smaller company with just a few employees. Each employee is able to contribute up to $16,000, plus the business can match it up to a maximum of $29,500. So that's a little bit nicer than just the SEP. Or we might also want to look at a 401k, and there's lots of different kinds of 401ks. I myself work with a firm out of Florida who does customized retirement planning, and I love working with them because they work with my clients in all the different states in the US. And in a 401k, as an employee, you're able to contribute up to $23,000. And then with the employer match, you can get all the way up to $69,000. And there's some other customized features and stuff that can be built into these plans, which can make them a very valuable part of your tax planning. Another one that people don't talk about very often is hiring your kids to work in your business. I love this one because it allows us to take some taxable income that's sitting at your tax rate, which is probably somewhere in the 40%, maybe even higher rate, and decrease your taxable income by passing it down tax-free to your kids. The way this works so well is because our standard deduction is high now. For a single person for 2023, it's $13,850. Well, that's quite a bit of money that you can pass down to a kid. Now, there are some rules regarding ages and limits of their duties and things like that. You do have to keep good records, and you're going to treat them just like you would any other employee in your business. But it's a great way to use this money and pass it down to your kids. Maybe have them put some of it or most of it into a Roth IRA and let it grow tax deferred. Or actually, it's not tax deferred in a Roth. Let it grow year after year after year and pull it out with tax-free growth on the growth piece of it. So I wanted to tell you a little story about Mike, who hired his 16-year-old son to work in his landscaping business. Mike was able to have the kid help during cleanup around the job site, and he was able to have him help his other normal, regular employees with planting and mowing and some things like that. During the summer, he was able to pay his kid about $10,000 over the course of the summer and into the fall, kind of during their peak season. Well, this kid was saving up to buy a car. And so now we were able, in essence, to purchase that car with pre-tax money because because his son was on payroll for the business wrote it off as an expense. He didn't have another job, so he stayed under the $13,850, and we used that money and let the son go ahead and buy his car. Now, hopefully, Dad talked him into also putting some of that money into a Roth IRA, like I mentioned earlier, and let it sit out there and grow tax-free over many, many years, since we're starting with a 16-year-old child. So this is a great way not only to teach your kids about fiscal responsibility, but it's a great way to give them a start for their own retirement and have it with lots and lots of years and room for growth. The Augusta rule is another one that I hear very few accountants talking about. This one is pretty cool because it allows you to legally rent your home to your business up to 14 different days or different times out of the year. Your business takes a write-off for the rent that they pay you, and it's tax-free to you on your personal return. So the way to make this work in your business is we have to do some research and get comps. What would you pay another location, whether it be a local conference room or a meeting room in a hotel or something along those lines? What would you pay for it? And then you can charge yourself a similar rate, but make sure you keep good records. Keep your agenda from your meeting. Take pictures if possible. Build a file to show that this was a legitimate business expense. What if you did a monthly shareholders meeting or a monthly officers meeting or something along those lines? Or you had your crew over to your house and you did a training, maybe followed it up with a barbecue or something afterwards. But this is a way that you can legally utilize your home and take a write-off through your business. A lot of times I see my clients saving about $1,500 a year with this strategy. How about being able to write off your medical costs through your business? And you're probably looking at me like, what are you talking about? I can't write off my medical costs through my business. Well, if you have a medical expense reimbursement plan and you have a Schedule C and you're married, you could very easily write off those costs through your business. But you do need a spouse, you do need to be married. You could potentially pay your spouse through the reimbursement of health insurance costs and other related costs, medical costs, in lieu of actually putting them on payroll. So there's ways to make that work. The other choice is to do an HSA, which is a health savings account, which is a high deductible account, and we're able to help fund that account on behalf of our team and take some deductions in our business for that. So the end result, I'm trying to move this through into your business instead of on your personal, where it's potentially not even deductible anymore, equals some tax savings. Previous to 2017, a lot of people were able to deduct their medical expenses. Very few are now because not that many people itemize their deductions anymore. Let's briefly talk about the right entity choice. Are you operating in the correct entity choice for where you are in business today. We have lots of different choices. The first one is a sole proprietor. You may not be aware, but that sole proprietor business offers you no liability protection, which can be huge depending on the industry that you're in. And you also pay self-employment or SE tax on the profits. That can become very expensive if you have a successful business. So sole proprietor or a single member LLC will also pay SE tax on the profits. Well, then our next step up is an LLC. Depending on what state you're in, if you're in an LLC-friendly state, we get that liability protection that we're looking for. We put a fence around our business and we start insulating our business from our personal assets. But you may pay self-employment or SE tax on the profits. If you're single member, you'll end up filing a Schedule C on your personal return, pay SE tax on the profits. If you're multi-member, you're going to default to a partnership, and there again, you'll potentially pay SE tax on the profits of that business as well. The next step up our ladder is an S Corp. In an S corporation, we don't pay any SE or self-employment tax on the net profit of the business, but we are required to take what the IRS calls a reasonable salary, and I'm going to put air quotes around the word reasonable. The IRS determines what that reasonable salary is. It has nothing to do with what your sales are. It has nothing to do with how long you've been in business. It has nothing to do with how amazing you are. It has everything to do with the different duties that you do during the course of a week. As a business owner, we wear many, many hats. And so during the course of the week, we do lots of different kinds of duties and tasks and projects. And so we would, in my world over here, we do a reasonable compensation analysis for our S corporation shareholders. We want to make sure that they're taking enough payroll to satisfy that reasonable compensation rule with the IRS. So my question for you is, which of these entity types most benefits your situation of where you are today and where you're going to be for the next few years? Here is just a little case study of our entity choices. Don owns a plumbing company with gross revenues of about $1.5 million and a net profit of $200,000. If he was a sole proprietor or a single member LLC, he would pay about $24,511 in self-employment tax. Well, when he's an S corporation, he's not going to pay the self-employment tax, but he is going to pay payroll tax on that $70,000 salary. After he pays the $70,000 salary and that payroll tax on that, he will still be ahead by a little over $10,000. So my example is $10,710 that he'll pay in tax, leaving us with tax savings of $13,801. So it's an amazing way to be able to shift some tax and get some tax savings for you. If your sales are upwards of 4 or 5 million on up, we ought to be talking about utilizing a captive insurance company. You're probably wondering, what is a captive insurance company? Well, it is a real insurance company that is owned by the business owner, and it allows you to self-insure for many risks that aren't covered by traditional insurance plans. I see my clients insuring themselves for business interruption, possibly loss of a key customer, or loss of a key employee, or subcontractor default. There's lots of different risks that you can self-insure for that are not being covered by your traditional insurance because you couldn't afford the premiums if you were covering everything. So I just wanted to give you a picture example of what a captive insurance looks like. You have your business there on the left side. It is the insured. The shareholder or shareholders own the captive insurance company. So profits are paid into the captive insurance company through insurance premiums. The captive insurance company then holds that money and pays any claims that might need to be paid back to your business. And meanwhile, what is left in the company starts to grow. And pretty soon you have this nice investment sitting out there that has been growing potentially tax-free. Your business will take a deduction for the cost of the insurance. If they make the election to be taxed under the IRS Section 831B, your captive could qualify for a 0% tax rate. And that is a heck of a lot lower than the possibly 40% rate that you're paying yourself between your federal and your state income taxes. But the whole reason that we do this is not so much for tax savings as for covering mitigation or minimizing potential losses that could happen down the road. I'll use the example of COVID. That's not so far back that we don't remember that. There was many companies that were hit hard and their states required them to close down. Well, those that had just traditional insurance and they tried to submit a claim to their insurance company, they were unable to get money from that for the most part. There was enough exceptions in their policies that they weren't able to cover anything. But for those who had a captive insurance company, they simply submitted a claim to their captive insurance company and were able to withdraw funds or from the claim and put it back in their business and keep right on operating. So it's an amazing tool that also gives you some tax savings. Cost segregation is another area we should be looking at, especially for those of you who own maybe your own office building or your own shop building, those types of things, the bigger pieces of property. When we do cost segregation studies, we break the property down into the land, 5-year property, 7-year property, 15-year property, and then the rest of it is sitting out there at either the 27.5 or the 39 years, which is according to the IRS depreciation schedule rules. This allows you to front load your depreciation through some accelerated depreciation. Now, over the life of the property, you will pay the same amount or take the same amount of deduction for depreciation. It just allows you to take it in the earlier years and get a write-off for it. So it's a nice tool in the tax planning arsenal and one that we like to look at for our clients that own bigger buildings. Let's say you're selling your business or you're selling a piece of property, something along those lines. There are several different strategies that can help you reduce those capital gains through proactive tax planning. There's strategies around the 1031 exchange program or the 1031 exchange plus program. There's a plan called 100-to-1 plan. It reduces your capital gains from 100% down to 1%. There's an equipment rental strategy that allows you to invest money into companies that rent commercial equipment across the U.S. and take a big tax write-off, as well as get money coming in pretty much each month as a residual from that, and many, many others. So if you're interested in some of these types of strategies, please reach out. We're happy to have a conversation around these. But the most important thing of all is finding a proactive accountant or coach who's going to have these conversations with you and find out your situation, dig a little deeper into what's going on and not just do your tax return and move on. They've developed a relationship with you. They're aware of what you're doing in the rest of your life, not just in what is seen in the pages of your tax return. Because tax planning is so much more than just running out at the end of the year and buying a piece of equipment, buying a truck, buying a van, buying a heavy piece of equipment, whatever it might be. It's so much more than that. And it's something that happens throughout the course of the year. And it's something that should be looked at every single year as you're working with your accountant and your tax preparer. When you're choosing a proactive account, you want to be asking questions and thinking about, does this person appear to be entrepreneurial? How are they running their own business? Are they running it like an entrepreneur? Or are they just a technician, just doing the work and checking the boxes? Are they actively looking for tax saving strategies? Do you hear them in their or see in their blogs or their blog articles or their social media posts where they're talking about different kinds of tax saving strategies? Do they have a solid network of other tax savings partners? Have they put forth the effort to surround themselves by other very smart people who can offer ideas and suggestions and introductions and stuff. These types of accountants are very hard to find. There's very few of them around the US, but I will tell you they can be found. I myself belong to a group of some amazing tax planning strategists out there. And we meet regularly to help ourselves stay sharp and to come up with new ideas and new strategies. So these types of accountants can be found, and they're amazing when you find one. So let's wrap this up. Lack of tax planning can be a huge profit leak and a huge cash flow leak at the same time, because you're giving away money that you don't necessarily need to give away. It could be staying inside your business. Years ago, one of my very first tax planning clients, we were able to save him enough money that in a period of about 3 years, he went out and he purchased a commercial building for cash. He still owns that building today, and he's been collecting rent on it for probably close to 15 years now. And he has an asset that's gone up in value. It's a big part of his retirement plan. So it's really fun for me to get to work with people who have great goals like that, goals that are solid and that can be put to work and take the item that we're looking at that we're going to invest our savings in and turn it into something else that's making even more money for you. So those are great ways to be thinking about your tax planning. Just a little sidebar, my coaching members in my Profit Transformer and my Profit Amplifier programs receive tax planning services as part of their membership fees. So they're not paying an additional fee for tax planning. It's part of our monthly meetings where we're meeting. The value of this particular membership perk right alone, just this one membership perk, can range anywhere between $5,000 to $100,000, depending on the complexity of a tax plan. So just wanted to share that with you. There's tremendous value in tax planning. It's like putting $1 in and getting multiple dollars back out. Thank you so much for joining me on this episode of the Profitable Home Services Podcast. Remember, it's not how much money you make, it's how much you keep. Be sure and grab a free digital copy of my book, Your Path to Profits. And in this book, I share 9 profit boosting tactics that will transform your service business. And you can find that at yourpathtoprofitbooks.com. Once again, that's yourpathtoprofitbook.com. Thank you for joining me, and we'll see you in the next episode.